Welcome. Welcome to today's discussion. We are going to be tackling a very significant policy file for IAB Canada, but for many of our members and for just Canadians at large. Canada's digital services tax and the implications for the ad industry. With us today, we have Laura Gheorghiu. She is a partner and business law specialist in taxation. I was just talking about the fact that, none of us ever would have imagined that we would be dialing into a call to learn all about a tax in our sector. So here we are with a thought leader and somebody who is going to give us some really great insight into what all of this means for our industry in the digital advertising space. So Laura, I'm going to pass it over to you, and I'm going to ask participants today to please, if you have any questions, please use the Q&A or the chat, and we will try to get to as much as possible. The presentation today is pretty comprehensive, so a lot of this stuff may be covered in the talk, so just letting you know, but let's get started. Go ahead, Laura.
Thanks so much, Sonia, and thank you all for joining me this morning after, well, I think it's morning on both sides of the continent. The DST has been a very interesting topic for us because it's really at the forefront both of taxation, but really it's also a question of policy and government relations and politics writ large. So it's quite an interesting tax regime, but obviously has some real implications. And maybe if I can just give a quick intro of myself, I'm with Gowling WLG. I'm a partner in the tax group. I do a lot of work on cross-border international tax. I'm a vice president of the International Fiscal Association here in Canada, and I'm also for my firm the lead of our California desk. And I want to give a quick shout out to a colleague of mine, Eric Hendry, who's also in attendance. He has also a wealth of experience, having worked at the Department of Finance with the DST. So we have a lot of knowledge and trying to kind of grapple with these new rules. Gowling's is, I think, hopefully you heard of us before, and some of you probably have worked with my wonderful colleagues in the Advertising and Product Regulation Group. They have tons of experience in digital media and everything to do with apps and ad blocking and ad placements and all this cool stuff, native advertising. They're always explaining the new concepts to me, and so I'm really privileged to be able to have them there to help us work through some of these rules. The idea today is give you a high level of summary of what are the DST rules as they apply to the ad industry, go through a few examples, and then we're going to open up the floor to questions so that you can ask us your burning questions, and hopefully we can give you some helpful answers or directions. If we can go to the next slide. Okay. What is the DST? You've probably heard of it. I just want to go over really quickly who is caught, and I think the who is caught is a little bit. It's easier to think you're not caught than otherwise, but I think it's important to keep it in mind. There's a concept of global revenue threshold that exceeds 750 million euros. So this is about the group, the consolidated group of companies, which is a financial statement definition, must have global revenues over 700 million euros. And you'll say, why euros in Canada? Well, that's because the Pillar 1 of the OECD, which is supposed to be the all-encompassing multinational agreement for dealing with these kinds of taxes, has that threshold, so they've borrowed it as well. And if you looked at the French DST, which has been around for a few years now, they also use the same 750 million euros. Obviously, kind of problematic from a Canadian group perspective, and even from other jurisdictions like the US, because usually the tax returns or the financials statements are not in euros, and so you'll have this conversion issue. And so when you're at the margins, it can be hard to say that you may or may not meet the threshold. And then you have the second threshold, and the second or two more thresholds, and these are about Canadian dollars, and what we call in-scope revenues. I'm going to talk about these 4 buckets focusing on online advertising, but 4 buckets of what we call in-scope revenue, that is tied to Canada, and so Canadian revenues called. And when you put these buckets together, you just pour in all the revenues from these 4 buckets. If you meet a 10 million Canadian threshold, you're required to register. And if you meet the 20 million threshold, then you have to start paying the tax. And the difference there is that I think the government is trying to give itself some audit powers by saying, please self-identify as high risk, and then we can audit you and see if you didn't meet the 20 million threshold. And obviously it's always you say, well, don't have to register, but not registering when registration is required comes with penalties, and they can add up. I think it's about 20,000 a year, and it can go up from there. So what happens if you have to pay the tax? Well, if you exceed the 20 million Canadian revenues, then you have a 3% tax to pay on that. And we'll go into it later, but it's really important to understand it's not a profit tax. This is not a tax that works the same way that a income tax would work. So if you have profits, you pay the tax, and if you don't have profits, you don't pay the tax. This is a revenue tax, and it just gets triggered the moment you have the revenues. Also, the calculations don't match normal tax years. So it's a calendar year calculation, meaning that financials need to be recalculated for the calendar year if you have an off-year financial year, or off-calendar financial year. And I think this has had a lot of been distributed a lot already, but there is also the issue about the retroactivity activity, because those companies who were subject to this tax have to actually comply and pay the tax from 2022 to now. So somebody who says, oh, I fit into the test in one of 2022, 23, 24, must file by June 30th next year a return that covers all 3 years that are within the thresholds, and pay the tax at the time. So that's kind of an interesting thing, because it's a little late to go and recalculate these years, and you may not have tracked things the way you would have wanted to, but there are some other rules there that help you use this year's rates for past years as a stand-in. So kind of complex, very new, and different from what we're used to and what the tax accountants were probably used to seeing and tracking for you. And I see already a lot of questions, but let me see here if I can.
Yeah, if we can just wait to the
Yeah.
end, because I think that you are covering a lot of this, and some of it will, it'll be good for us to just capture all the questions so that we can then summarize and roll up the questions for you in an organized way at the end. So thank you for that, and by all means, please keep asking questions also. Thank you.
Absolutely. And just I think Melanie has asked, is the global revenue threshold digital only or total revenue, including print and content? It is all. It is, if you're selling widgets and happen to also have an online marketplace where you sell and do any of these, what we call in-scope thresholds, meaning Canadian online marketplace services, that's like fees for listing things on marketplaces, online advertising services, which we're going to deep dive into, social media services or user data, which is defined as well, you're going to be caught by the 2 rules. So it is first, do I make enough money? And second, do I make money from the right kinds of activities?
And the global revenue threshold, though, of the 750 million includes non-digital revenue as well.
Everything.
Yeah.
It includes every kind of revenue you can have. All right. And so thanks for the next slide. So do I have to worry about this? Because if you don't have to worry about this, you have a whole extra hour to your day. My way of thinking of it is, if you think your global group could meet the 750 million threshold, you need to test whether you have one of the buckets of revenues that could be caught by the rules. And more broadly, if others in your chain of supply are caught by these rules, you need to consider how that will impact you on a costing basis, because there is, and we're going to talk about that, probably a potential for the pass-through of these taxes to the consumers writ large, meaning the user of the end user of the service. So we talked about consolidated group, we talked about profit. How do you calculate this thing? So you have these 4 buckets, and the 4 buckets are supposed to be mutually exclusive in that they don't double count. And in each bucket, there shouldn't be double counting, which is different than double tax. You could have double tax, but not double counting. And then you have these definitions that have sort of public usage, but they're not as intuitive when you go through the tax definitions. And I think there's going to be a lot of debate around what some of these terms are meant to mean, and also what does it mean to be connected with Canada? And we'll go into that a little bit in more detail as well. Go to the next slide. So the focus is on online, important, so online, not print or other physical media, targeted ad revenue connected to users, to platform users in Canada. And so you really have 2 sort of sides of the coin that both could be caught, which is either that you're facilitating the placing of these online targeted ads, or you're the host of the targeted ad. So one of the 2 payments are caught, but they're not supposed to be double counted. And so usually if you're trying to say, am I caught by this? You will be caught if you either place, transmit through a digital interface, an online targeted advertisement. You earn some revenue from that, either because you're facilitating or you're hosting, and the ad is somehow associated with users in Canada. And if you say, what is a digital interface? They've offered a very broad definition. I wrote down here, any electronic medium through which data or digital content is collected, viewed, consumed, delivered, or interacted with, including a website or an application. So they're trying to catch everything they can, and they're sometimes saying, well, if a number of elements together make a digital interface, so maybe a website with another app and a little API, then all those things together could create one digital interface. But if your business has different digital interfaces, that could be 3 or 4 different digital interfaces. So as I say, the devil's in the definitions, really, because it could be that certain definitions have an impact on whether or not an item of revenue is caught. So we go to the next slide. Okay, so I have to have an online targeted advertisement. What does it mean? It's supposed to be a very broad meaning, and it's supposed to focus on ads that are through this digital interface that use user data for targeting based on one of the characteristics, so either demographics, location, behavior, time, browsing, any of those things. And it could be also a passive action. So I think, as an example, I'm right now traveling in the US. In Canada, I don't get as many targeted ads based on my location, but in the US, the rules are a bit different. So that's allowed a little bit more than in Canada. And I've been getting all these ads for hotels out here where I am, because my location, my GPS is telling the system, hey, Laura is in the US, she might be needing a hotel. So that could be an example that's of a passive targeting of an ad. You don't always have to interact with the system as a user to be receiving ads that could be caught by these rules. And it's also about prominent placement on the website for promotional purposes. That's the classic Google ads where the hotel comes up first and then all the other search results, any sponsored content, but does not include, and that's going to be where it becomes interesting, ads that are contextual ads. So, I like to read travel blogs. They might get a hardwired ad in there for hotels because people who read travel blogs probably want to go stay at a hotel eventually in that location. And so it's really because of the context of the website that you have the ad, and not because of what I've been doing vis-a-vis that website or my other usage. And so those kinds of ads are not included in this. But it can become difficult to show and trace. I think the problem is not so much always the definitions, but it's the evidencing of what should or shouldn't be included. And I love all the questions. I can't read them super fast, so we will get to them all at the end. Couple of other points.
Just try to block them out. Try to block them out, Laura. And we're keeping track, and then we'll get to them. Don't worry.
Absolutely. So I just want to focus on two more definitions. You have this concept of user and user data. So the user, it could be an individual. And even traditionally we think, well, user must be an individual that is interacting directly or indirectly. Exactly my example, like I'm passively interacting. But it could also be an entity like a corporation. So if you have users from a certain corporation that you're targeting, for example, you have you're targeting Gowlings with a product that we could use as a law firm. And so a bunch of us are getting the same ad. Gowlings would be the user in that context. And it wouldn't be usually the user would not be the operator of the interface or an employee of the operator. So if it's Gowling's website and we have ads, well, those ads that we see ourselves would not be, that revenue would not count. How you track that, I don't know exactly. And this idea of interacting is also very broad because it's trying to catch all sorts of behaviors that are not necessarily very active. So, and then user data, and that's another one that I think is important. It could be really any interaction with an interface that represents informations or concepts generated by or collected from this interaction. So it can also include analytics. I think that's really important as well. So
And just one
yes.
point before, because it's a small-ish question, but included in here, and I think Bill William raised this. Is CTV included? And my suggestion is yes, because it uses all that data and it is transmitted digitally, right? So a CTV, meaning a connected television ad, a video unit that is bought and sold programmatically, is going to be caught in the crosshairs here, right?
So it's hard to say. I have not done the analysis on that, but I think there is a question mark, right? Because of the digital aspect. I mean, I think the idea of these definitions are intentionally broad in order to catch new kinds of ways of doing things that we do not yet imagine when we're drafting them. And I think all of what they're calling digital rules like the DST, and there's another one for sales taxes that was brought in a few years ago. They were always intended to evolve with the evolution of the marketplace of the supplies. So William, the answer is maybe. And I think that the problem is getting that certainty. Sometimes it's possible to ask for a interpretation from the CRA to say, well, here's our facts. Would you say this qualifies or not? My experience, unfortunately, with not the DST yet, because it's just come into place, but with the sales tax rules that were for digital services, that was the sales tax rules for non-residents selling to Canada and having to collect sales tax, is that there's so many questions that it takes years to get an answer. So it's not very helpful in the short run, but definitely something that's a very good catch there. Okay. So what kind of revenue do I have to worry about? We've talked about the facilitating the delivery, and we've talked about the providing the space for the ad. So you can see both sides would need to worry about this. The concept says we shouldn't have intra-group payments and some intermediary payments be caught by these rules because it should only be taxed once. The revenue should only be taxed once. under the DST. I'm not talking about other countries, and I'm talking about the DST itself should only tax an item of revenue once. So if you have more than one, and we'll talk, I think there's an example a little bit. If you have more than that amount is being passed on, or there's a block amount collected and then it's split between different participants in the chain, well, not the full amount should not be taxed every time. And I think here what's important, and sometimes we have that issue, is that if your revenue records the full amount as revenue, if your financial statement records, and then you have a deduction for what you have to pay out to others, that doesn't work. It makes it very difficult to carve out the parts that are paid out, because there's no, this is a tax on the revenue line, not a tax on the profits line. So the deductions you take when you pay other parties, if you take them after the revenue line, they won't really be recorded as deductions for purposes of this calculation. So it might shape how revenue is recorded, to really just record the amount that you get to keep rather than the total amount minus certain payments out. I'm going to go into an example a little bit and we can flesh that out a bit more. So when is the revenue connected to Canada? And this is quite interesting and I think not easy to calculate. There's obviously the revenue that is clearly connected to Canada, because it can be attributed to an instance of showing the ad to a Canadian targeted user, or where a target Canadian user is interacting with the ad, like clicking on the ad. So it's easy to track there that either, Laura sitting, I call it eyeballs in Canada, Laura has seen the ad or she's clicked on the ad. And it's really about where unlike the other items of revenue, this one worries about where you're sitting when you see or click on the ad. So you're capturing not only Canadian residents, people who are always in Canada, you could also be catching people coming through Canada and who are seeing the ads. And that could be very important for target advertising. We don't see it as much in Canada yet, but things like, you walk by a restaurant and you're a tourist and you happen to have your GPS on, so you're getting a targeted ad for that restaurant, and you're from France. Well, it doesn't matter. You're in Canada. When you see it, you're caught. That revenue is caught by this rule. And that's 100% of that revenue is caught and included in the bucket of ad revenue for purposes of our calculations earlier. Then there is also, and so the kinds of data that's used to make that determination is, again, the addresses, telephone numbers, IP or GPS data that you can use to track that. And now there's also a scenario where you cannot track the user's location. And that is a little bit of a harder one, because they also want to catch that kind of revenue. And in that case, there has to be calculation done to allocate a portion of that income or revenue to Canada. So if we go to the next slide. So this, again, I think we talked about what traceable versus non-traceable. This is just an example, but basically it's 100% of your revenue is taxed in Canada. So if you're getting, 0.01 cents per ad and you have 100,000 ads to Toronto-based users, well, you have $100 of revenue that could be subject to the DST. If we go to the next slide. Okay, so what do I do if I have non-traceable revenue? How do I calculate that? So this is an interesting one, because they're saying, well, you have to calculate a percentage to determine how much of that revenue needs to be attributed to Canada. And you don't get one percentage. You have to go ad by ad and determine what's the percentage that needs to be attributed to Canada, which, if you have a lot of ads, could be quite demanding. And their calculation that they're asking, the formula that they're telling you to do, is to say, okay, let me see of the number of times during the year, the calendar year, that the ad is displayed to a user in Canada where I can trace it, divided by how many times is displayed to users that are traceable but not in Canada. That gives you, let's say, you display it 100 times, and of that, 20 you can identify to a location, and 10 of them are in Canada, and the other 10 are not in Canada. So 10 divided by 20, so 20, half of all the traceable ones are in Canada. And then you apply that ratio to the rest of the non-traceable ones. And so half of the non-traceable ones must also be in Canada for that ad. And that gives you 50% of the revenue from non-traceable is attributed to Canada. And you take that from ad A and then you do ad B, C, D, E, and you add it all together. And that's how much you have of ad revenues that could be subject to the DST in Canada. So
Laura,
quite a lot of work to do there.
Laura,
Yes.
in terms of accountability there, just if, is there then the requirement to keep keep records of this, because this will then have to be submitted with in terms of the process, are you going to be required to produce documents that is accurately calculating this with some sort of accountability framework built in?
Absolutely. Normally we have, for all tax reporting that we must do, records must be kept for 6 years from the last date that they're relevant. So in this case, from when you calculate it and have to pay, let's say for 2024 year, you have 6 years from now, you have to keep the records, and so that they can then be audited, right? And that also shows us why there was that 10 million threshold for registration, where you register, you report that you don't need to pay anything, but they can also come and audit and say, well, show us all your non-traceable versus traceable revenues. We want to understand how you calculated and how did you arrive at the 10 million versus 20 million or more threshold. So that's why you need to keep records. But I always say, when you're looking at whether you're caught by a rule and how to protect yourself, you do not want the CRA to make the calculations for you for the first time. You want to have your own backup and your own calculations, not only because you're required to produce the evidence of how you got to the calculations, and also just evidence generally, anything there is a quite broad audit power, and where they will ask for the kind of information they might need to make these determinations. But I would never want to give raw data without having processed it myself first, to also know what numbers they should be getting to, because if they come up with crazy numbers, now I'm sort of coming off of the back foot, trying to discourage them from those conclusions, instead of coming and saying, well, here's what we got to. Look at it with us and see whether it makes sense, or on what basis do you CRA disagree with us. And when there's kind of any kind of uncertainty, you prefer that your facts are strong, rather than leaving it to them to decide, because you might get some helpful conclusions from them instead. So the answer is yes, is the short answer, but the long answer is it's in your best interest to do that anyway.
Yeah, so that's quite difficult now for the retroactive portion of this to go back into your records, and I'm wondering, how traceable all this stuff might be.
Yeah, and I think, and that's why they
fine.
have sort of this election you can use, where you take your 2024 ratios of revenues that are subject. Let's say of your 100 million revenues from Canada, 20 million are, so 20% are subject in our ad revenues, for example. Well, they allow you to, roughly speaking, apply that same 20% ratio to what you were earning in 2023. So let's say you made it 200,000, and you would say, well, 20% of 20 million in 2023 is probably ad revenue. And so you would just kind of use that ratio. It may or may not be helpful, because it may not be consistent depending on what your business was doing. Were you on ramping? Were you, are you kind of downsizing your activities in Canada that year? Who knows, right? But there is that option. And it's accepting that people didn't track, and it's hard to go back and track things that you were not prepared to track for. So there's some flexibility, but granted, it's not going to be that easy if you want to do it by specific numbers.
Thank you. Thanks.
Okay, perfect. This is the slide I was talking about earlier. So this is just trying to show that technically, if you have an ad, the same 250 is paying for everything here, right? You have an advertiser or marketer placing an ad through an ad server on a website publisher's website, and then Canadian eyeballs are seeing this at the rate of 25%. And so 25% of that revenue, and I don't know if the math was very good here, but let's say the 25% was $250, right, of a $1,000 of revenue. So 25%, the ad server should not be putting a 250 in their income. They should be putting $100 because that's what they get to keep, and that's what will be subject to the DST calculations. And the website publisher who's getting 150 of that 250 will be putting 150 in their revenue, and that's the number that you have to look at to see whether they meet the threshold and if they have to pay the tax on that revenue. So that kind of shows you the concept. I think in practice, I've seen scenarios where there is a really weird kind of backwards billing or self-invoicing, and these numbers do not show up properly, and there's going to be a lot of confusion on the part of CRA when that happens, because it's really hard to convince somebody if you have a sales invoice for a number and you put that in your revenue, and then you take a deduction that your revenue was not 250 but actually the $100 that you got to keep at the end.
I mean, let me just say what a cluster this is going to be, right? Because the aggregated reporting from the ad servers are, I mean, that's going to be a nightmare to go through to figure out what percentage goes where, right? So anyways, I'm just, sorry, thinking out loud, muttering.
Yeah, and then Eric is just dropped in the comments that there's actually an 8-year requirement to keep records, so even longer. And I think the reason for that is that there is sort of an international component to this, and the Canadian government has tried to extend their reassessment periods, or the periods to be able to go back for anything that has an international component, to 7 to 8 years, specifically because they think it takes longer to audit, and they think the amounts are really important. All right, so we've talked about ad revenue, but I think, and that's why I talked about buckets. You know, you have little buckets, you go one by one, you fill it with what revenue is Canadian in each bucket, and then you put them all in one big bucket, and then you say, oh, do I meet the thresholds and do I owe the tax? So it's really a bucket by bucket analysis, and then a consolidation or totaling of the amounts in order to run those tests at the beginning, which is, do I have 20 million or more Canadian in scope revenues? And if I do everything over 20 million, it will be subject to a DST tax. So the other revenue streams that could apply here and generally apply are online marketing revenue, social media revenue, and user data revenue. Online marketing revenue is a little bit easier to conceptualize. It's sort of the platforms that facilitate the supplies between users, and that's defined quite broadly, where at least one of the two users is in Canada, of anything that's a goods or service to a digital interface. And there what they're catching is that fee that you charge or could be charged for facilitating that supply. So it's not about the sale itself of what's being sold, but really about the fees collected for facilitating the supply. There's the social media bucket, which is really about non-advertising revenue from a platform whose purpose is for facilitating interactions between users. So that would be premium subscriptions or things like that could be triggering. That could be subject to a fee. And then you have user data revenue, and this one is actually narrower, thank goodness, than you would think, because it has to be user data that is collected by the entity or a group of companies from either the online marketplace or a social media platform. So it's not your user data writ large, because you track your customers that do a certain activity, and all of a sudden now that sale of that data is caught. It has to be data that comes from either an online marketplace or a social media platform. So that is helpful from that perspective.
Just to ask a quick question about that. So user data revenue. So for the purposes of using a clean room, the anonymization of data for the purposes of advertising. So the good service there is the facilitation of hashing of new data, right? So the hashing and producing new data sets out of it. I know that's it's a little bit more complex, but you know, would that be captured into that narrow definition? Because you're generating, right? So two parties are coming to the party with their own data sets, and the central clean room is creating almost like a new set, like producing a new set of user data for the purposes of advertising.
So, I mean, and we go into it a little bit later, but conceptually, and there's not really been any clear interpretations, but that's sort of our way of seeing it for now. When you're offering a service to data, right? Because this is a little bit what you're suggesting. It's not the data of the clean room, and nor is the clean room, it's well necessarily, you know, the collector of that data at all, but there's a service being applied to the data, which is about anonymizing it for whatever usage comes next. And so that service itself shouldn't fall into these buckets, right? Because it's not the sale of the data that was collected by that entity. It's really a service applied by that entity that happens to be applied to user data collected.
Fabulous.
Right.
Yeah.
So I think that's how I'm seeing that that concept. Now there could be gray zones, and I think I'm always careful because we haven't yet thought of all the alternatives, and I don't think the tax authorities themselves or finance department could have imagined it all, because as very smart as they are, it's really when you start applying the rules that you see the problem areas. But conceptually, it shouldn't be applying to that service.
Yeah, that's great.
And
That's very helpful, and
yeah,
also in the way that we think about describing our services. That's very helpful. So thank you. Yeah.
yeah. And so if you go on the next slide, it's just about this concept that it goes in when you take an item of revenue, you kind of test it from one end to the other. So you go, okay, is this revenue online marketplace revenue? No. Okay, then is it ad revenue? Doesn't meet the definition. Then is it social media revenue? Yes. You stop there. You don't go to user data. So you kind of have to go through. It's not supposed to be double counted in that way either, and that it can't, you know, it shouldn't be both one and another and be subject twice. And but there's a sort of ranking that they've kind of come up with of how that should be working. And I think that's important to also keep in mind as you're doing this analysis. So this is an example here of revenue from facilitating transactions between users on a platform, preferential listing service fees paid for a fee. Part of the service involved preferential search results, target certain users. Well, the revenue should be online marketplace revenue because it's triggered right away, even though maybe in a different context, it could have been online advertising services revenues, right? And the rules, and we didn't go into the details, but sometimes the tracing rules are a little bit different for the online marketplace rule versus what the online advertising rules are. So when is the person in Canada? How much Canadian presence is it? Resident versus temporarily, GPS found to be at that location could be a little different between the two, which is just a bigger headache, and which is why also you want to start at the top and go through each one. Ideally, I think when a new service is brought on board, if you are generally subject to the DST, you should be doing an analysis to say, okay, where does this fit in the hierarchy of these kinds of buckets that I could be subject to DST on? And if once you know where it fits, then you say, what's the test and what kind of information do I need to collect in order to meet my obligations and classify it properly under that of in-scope revenue, or I'm calling bucket, but it should be called in-scope revenue. So it's because the tests are not always exactly the same, and definitions are not always exactly the same either. So if we go to the next slide, okay, this is just a little bit of, and I think Sonia, you've sort of raised it, like any kind of activities that are services to the data should not usually themselves be caught, because it's not about selling data. So if you're doing market research and providing intelligence or data mining in some way, this is not a sale of user data that you've collected. It is really a service to the company that's collected data that helps them understand what the data means and how to use it, etc. if you're a consolidator of data that is collected by third parties and you resell it, that also should not be caught by the user data bucket, and is probably not in the online advertising bucket either.
Also extremely helpful, right? That's very helpful in calculating the size of your bucket, because that can be deducted and make a significant impact for many of our members. That's great. Thanks.
Yeah, and the other thing is that when you're looking at data, let's say you do have data that is collected and sold, there's sort of a question whether passive collection could be caught. I think there is a risk that even passive collection, allowing something to be on your site that collects it passively for you, for your use, for your sale, I think it could be an issue, but there could be models where it may not be caught. And again, the data has to come from an online marketplace or a social media platform or a search engine. It can't just be data that comes from your website only. So tracking people who are on the website that you have is not, unless you are, the social media platform yourself, or a search engine yourself, or an online marketplace, Gowling's website, for example, would not be that kind of marketplace or platform that would be caught if Gowlings were collecting user data, which we are not, because we are complying with all of the privacy rules that are in place in Canada. All right, next slide. Okay, and the same thing, data collaboration, where it's basically services to data, onboarding data, analyzing data, probably not themselves caught. If you have a marketplace where you facilitate the sale of data between sellers, the service fees might be caught as marketplace services, and so that marketplace revenue, so that could be caught itself, but not necessarily the sale between the two people, unless from your perspective. It could be that the person who goes there and takes their data that they've collected off of the right platform and sells it to somebody else, that person might have also data revenues themselves. So it's a little bit not as broad as it first sounds, because of how the definitions fall on each other. And the same thing, if you have tracking platforms that offer tracking services, again, usually they're not caught. And anything that is tracking price, like the offering the facilitation of transactions by offering payment services, that is excluded already from the online marketplace revenue definition. So if you're just there to help collect the payments, that will not catch you under the online marketplace revenue rules. So I think that's what we want to say there. And sorry.
Yeah, just to clarify there, just because many of our agency members, the holding companies, they do depend on third-party fintech, right? That is specialized for media services, and it does more like a software as a service. So when you think about something like we can look at like a billing system that is software as a service, but that also, to broaden the question, Salesforce, right? Like a CRM system that is managing, and you're paying a license fee towards Salesforce, and on a monthly basis, would CRM systems and systems that are software as a service be caught into it? Because presumably it's a service, right? Like it's a digital service that you're providing.
Yeah, it depends what you're providing, right? The marketplace services means you are facilitating a marketplace between more users and purchasers. Your own website is not a marketplace usually. So if you just have a website where you sell shoes, and you use a CRM sort of support system to help you do your payments and your checkouts and your whatever invoicing, sales tax calculations, none of this is between there's only one supplier, which is your website, and a bunch of customers, but you don't have, the the classic marketplace, a bunch of sellers and a bunch of buyers, and you're helping facilitate that sale. So generally the website that is being facilitated through another company would not be caught by online marketplace revenue rules here.
Okay, great.
Okay, and so this is sort of the, what does this all mean? And I don't have the future telling abilities that I wish I had, because then I often joke I'd be on a beach somewhere having made all my money I ever need. But obviously there's going to be some who are caught by the rules, which are going to create a additional cost in the system. Usually, and we saw it, for example, with the carbon taxes in Canada, when there's a tax on a generator of something, or doer of something, whether carbon emissions or digital services of or in scope services that we've described here, it is often shared very generously with the next person in the purchasing chain, meaning that it passed on down the line, usually as an item or not, depends. But definitely it increases the cost either way, because it is just another cost of doing business. There's, people have asked me, Laura and Sonia, you and I had talked about this, does it unfairly tax some people versus others? Does it even the playing field? It's hard to say, because it's not a tax only on non-residents of Canada. If you are a Canadian resident group, if I can say it, who meets the 750 million euro threshold and does enough of the in-scope activities to meet the 20 million Canadian threshold, you will also pay this tax. And so it's really about larger entities as a group revenue threshold that could be caught, but it's not necessarily Canadian versus non-Canadian being caught. And it is actually not that hard, and it's great, because it means we have successful companies to, if you meet the threshold, to then worry about whether you're doing enough of the in-scope activities to be caught. In terms of, we talked about no double counting, which is again in the DST system, you don't double count the same revenue, but there can be double tax, because if you're a non-resident of Canada, or even if you are a Canadian, the DST is not an income tax. The DST is a tax, but it's not. Taxes just means where does it go in the government coffers, and it has to be going in general bucket of government revenues and not spent for a specific purpose. But it doesn't get treated as an income tax, and that has two implications. One, in Canada, it doesn't offer you a tax credit against your income tax payable. So if you have your revenue and then you have expenses and you get a profit and you multiply that by your tax rate, and that's the tax you owe, that the DST does not have you don't get tax credit for the 3%. You get a deduction as an expense, the same way you got to deduct your fees to Gowlings and your costs of employees, etc. But it's not directly reducing the tax you owe at the end as a tax credit. And a 3% deduction, sorry, I can say deduction, is a lot less useful, or less reduces the tax payable a lot less than an actual credit for the amount you paid, obviously, because it's before taxes. In the international context, if you're let's say a French company and you have activities in Canada and the revenues are subject to this DST of 3%, under the Canada French treaty, there's not usually relief, but also depending on the country, my understanding is most countries do not treat this as an income tax. And so they may not offer a tax credit for the tax paid in Canada. And a tax on revenue, because it's pre-deductions, can be quite a large amount compared to what the tax, the tax on profits might be in France. So it's, to be this determined whether other countries will offer it as at least as a deduction, as an expense you have to pay as a cost of doing business, or how do you treat that? And I think that's been a bone of contention. And when and if Pillar 1, which is supposed to be the all-encompassing, we all agreed and worked together to do this project of the OECD, gets enacted, it's supposed to deal with the double taxation issue. But because Canada's gone at it alone here, There is no relief in other parts, in other countries. And as I say, even in Canada, it's not actually a tax credit, it's just a tax deduction. And I think some folks were asking about this. I am not a policy person at all, and not at all a politician, but I do understand there has been threats from the US for trade action. There is a NAFTA dispute resolution process that has been initiated. I was looking just before this presentation back in 2018-19 when France brought in their DST. There was also some similar efforts made by the US government. And Canada's position for now is that they are going forward with this tax. And I think the prudent way is to see it as happening. It may or may not eventually be modified, depending on how things change and how governments change. But the marching orders, at least for now, are that it's going forward. I'm going to stop there, and we still have a little time for questions. I saw there were a lot of wonderful questions. I don't know, Sonia, if you have been tracking them and want to throw some at me, or I can try to read some here.
Yeah, I
Yeah.
think that you covered a lot of the ground. I think a lot of it has to do with the duplication, right? Like, so let me start by saying this. Okay, I think where our industry is struggling the most right now is in what does this all mean in terms of operationally getting ourselves organized, right? Like, so how do you keep records for this, and how do you one of the questions that came through was regarding how will we know when we're being charged the DST or not charged the DST, because the current accounting workflows and the current, I was mentioning the software as a service, it's not programmed to really have entries for that yet, right? Like to capture that. And that there's such an inconsistency in, whether or not somebody is going to be applying a surcharge, or whether somebody is not going to be applying the surcharge. So, so do you have any insights on, I know we talked about it with the government in our letter to say this is a gong show in terms of, operationalizing and completely onerous, but do you have any thoughts on how people should be thinking about this and organizing themselves and without giving legal advice?
No tall order. But the government only cares, I say cares, but they do care, but the government's audit powers and even taxing powers apply to the taxpayers, the one who will be subject to the DST. Whether that becomes a cost of doing business, as all taxes are really, that is passed along in the supply chain, is not something that they technically deal with. Sometimes they assume it, and we were discussing this in the carbon tax legislation. There is actually an exemption for certain purchasers of energy, and there's they kind of assume that even though the seller is the one taxed, they're gonna apply for the exemptions for their buyers. So they kind of assume that you'll pass on the tax in some contexts, but they don't usually deal with that in the legislation, because all taxes are, at the end of the day, making doing business more expensive than not. So I think how it's addressed afterwards is really a business decision. And there could be different choices of how you show it or not, don't show it on the invoicing, etc. But that's not something that they can address themselves. Although I understand it can be very unfair. Like at the end of the day, it is making it more difficult to carry on work here. I think in terms of how do you start complying with this is, there was a question a bit earlier, like, what do I look like? Well, if you take your financial statements and you look at your revenue line of your consolidated group, and you're close to 750 million euros, and you say, what exchange rate do I use? But let's just use today's rate. Then you need to say the next step you need to do is I need to start testing what revenues I generate in Canada, to see whether I am fitting into one of the in scope revenues and I need to pay the tax. But the best way to do that is to consider what kind of revenues do you generate generally, what kind of flows, and if you were to describe them, in a few categories, and have an analysis done of where does it fit? Is it from marketplace? Is it from ad? Is it from data collection? So because there is sort of, as I say, if you fit in the first one, you don't have to do the second one.
Mhm.
And then from there, sort of see what kind of data collection is this bucket, this in-scope revenue requiring of me? Because
Mhm.
it is different from marketplace services than an ad service that we just talked about,
Yeah.
then et cetera. So I think that's kind of how I would do it. And once you have that, I think it helps a little bit to focus on what kind of information you need to collect. But I am not aware that I don't think accounting, services are necessarily offering that. Maybe there are some really clever shops out there that are starting to do that. And I actually, that's a good point, and I'm going to have to dig a little further to see if that's something that exists already. But it will come, but it's going to be sort of build it as you're driving the the car and building it as you go a little bit for the first little while here, for sure.
Yeah, and I think that the sort of the acute issue right now is, where is it collected, right? I know, William, like I'm getting all your sort of questions here, and we're trying to sort of like triangulate the answers here, because
Yeah.
a lot of them are business decisions, right? So if you're going to do a pass-through cost, then you're going to have to do like a separate line item that is DST, like a
Yeah.
DST fee. And that will sort of be in your invoice. And so you'll have to work with your accounting software to sort of, facilitate that, and
Yeah.
be at the ready to explain it to your downstream to your client base. With regards to, at what point is the tax collected, right? How is it going to be collected, and who is going to be collecting it? I think all of that is business decisions, right? Who is
Yeah.
paying it? I think the paying it is like, the separate issue of who actually owes this tax.
Yeah.
And you're deciding to do a pass through. How are you going to handle that on your invoices, and how are you going to explain that to the marketplace? I think
Yeah. And yeah, and it's just
yeah.
go ahead, Sonia. No.
No, I'm just going to say the ambiguity that you were describing earlier is, I think, one of the most egregious parts of this DST, is because it's going to make it so that it's very easy to inflate prices.
Mm,
And nobody
yeah.
will be wiser on whether or not this was a DST thing or just simply, gouging opportunity to increase costs. And it's also de-incentivizing growth
Yeah.
for
But I just want to make one clarification. I think William has asked the question, and it's important. He says, well, you say that it's only taxed once, and so where does it get applied, at which level? It gets applied at all the levels. So there's sort of like two things to consider. One is who's paying the tax, and then, okay, who is business wise getting recharged. Okay, recharging again, that's not the government's concern, not what the tax does. Okay, it might be recharged, but let's leave that for a second. It's being taxed at each level of whatever you get to keep. So if you have, if you have the third party vendor and the ad tech, and they're each getting $5, well, they each put $5 in their bucket, and they could be taxed on it. But it could be that the tech company here says, well, I pay tax on this $5, so I'm going to charge you more. So it could be that, and oh my gosh, okay, so then I should charge the other guy more. So now instead of $5 each, we were
right.
making $6 each, right? So there
Yeah.
could be sort of a doubling up in terms of like you increase your costs, and therefore you pay tax on a higher number.
Yeah.
But it's not a sales tax. It's not like, oh, you are the payer because you're buying this thing from me. It's a tax I pay because I've done something, because I've offered to
Mhm.
either place the thing or receive or host the ad, right? So it's first you have the flow of what revenue do I have that's subject to tax, and then you might say, okay, but what then more practically, are my pricings going up? How's my cost going up so that my revenue is not $5 but $6? I think that's really important not to mix together.
Yeah.
Um,
Yeah, if we can look at just one more question. I know we're
okay.
we're running a little bit over, but there's just looking at Curtis's. I love the way that this is phrased, because it really helps to sort of solidify it. Can you clarify the threshold of limits, and how they're applied to business, from the perspective of an ad agency? Is it my total media spend? And so I think that this is a perfect opportunity to explain that it's not your media spend that's getting taxed. It's the media that you're buying is subject to the tax. And
Yeah.
so So if you have, let's say you have 5 vendors, those 5 vendors, of them, maybe 2 of them or 3 of them are subject to the tax, and they may do a pass through on you, or
Yeah,
they may not. And so you're going to have
yeah,
to decide as an agency whether or not you want to increase your prices to cover some of that, because you're going to find that your media dollar is going to be roughly 2.5% less effective,
yeah,
right? You're
yeah.
going to have to make that adjustment because suddenly the value of your media investment has gone down, because you're having to make up for either a pass-through cost or increasing costs that are hidden somehow to make up for this egregious tax. So,
Exactly. So this, and
correct?
so
Yeah,
it's not about as a buyer, if you're just paying money out, you're not subject to tax, directly subject to tax. CRA is not going to audit you on it. It's if it's the person who's receiving money, I mean, that has to worry about, okay, do I need to pay tax on this money that I've gotten in? So the first trigger is, am I receiving money?
right.
To make it simple.
Yeah.
After that, is everybody gonna have to pay more money? I even don't know. That my economics classes go very far back.
Yeah.
Perfect.
Okay. Listen, we are out of time. We are going to have you back. This has been really great. And then also, just some of you have asked whether or not we've received a response from the letter that we sent to, well, the Prime Minister's office, as well as to Freeland, and so we did receive a couple of responses back, acknowledgement of the letter. But a lot of finger pointing, a lot of, this has been referred to the finance minister's office, and, thank you so much for the feedback. We're going to be considering it. So, it's not over yet. We've got the infographic. We're going to put some media behind it, and show how deeply concerned this industry is about this tax. And, with that, I want to thank Laura so much for your help today in navigating this with us, and Eric as well, who's been really active in our chat. And we will do a follow-up. Absolutely, we'll do a follow-up if you're
Absolutely.
amenable.
I will be back, and just Richard, you asked, is it 2.5? It is 3%, but again, the chargeback could be any price, right? It's just I
Yeah.
guess you know.
Yeah. All right. Well, with
All
that,
right.
enjoy
Thank
the
you,
rest of
everyone.
your afternoon, and wonderful weekend to all members who joined. Thank you so much. Bye-bye.